We're joined by Nick Bloy, your co-managing partner with Navis Capital based in Kuala Lumpur. You were talking here at INSEAD at the second private equity conference about PE coming of age in Asia. And it's from your remarks, it certainly seems to have come of age, mainly after the Asian financial crisis. Now, you said that before the Asian financial crisis, private equity was something of a slightly dodgy industry. What did you mean by that?
Well, you remember I was talking to a group of MBA students who are sort of thinking about their career choices. And I think the point I was making is that in the 90s, choosing to pursue a career in private equity was, far from mainstream. In fact, probably it was far from usual for young professionals to make that decision straight out of business school. Most often they would be going into management consulting and investment banking and so on. And of course now you look at the attendance of the conference we've just attended. I mean, half of the full MBA body is here, all of whom I think are hoping to get into private equity. So it really shows how far it's come in the last 15 years.
But at that time, before the financial crisis, you were saying that the prestige was tied mainly to public companies, listed companies. Private equity was mainly carrying out minority investments, but then things changed during the financial crisis. How did that come about?
The concept of prestige is not so much that doing IPOs is a prestigious activity for practitioners, but the point is that business owners and entrepreneurs perceived there to be prestige in being the owner, the CEO, the shareholder, controlling shareholder of a publicly listed company. And so IPOs themselves were seen as prestigious by entrepreneurs. Now, in a way, that crowded out private equity capital. The public markets are an alternative source of capital to private equity, and that crowded out private equity. And so private equity really at the time, prior to the Asian crisis, could be considered the capital of last resort. And it might find its way into deals, but typically they would be minorities. No entrepreneur worth his salt was interested in selling control to private equity.
During the financial crisis, you see a lot of capital wiped out. I mean, billions of dollars wiped out, yeah. And a lot of firms go to the wall. And it's after that there's a shakeout within the industry, and things presumably get on track after that.
Well, I think the style of minority investing, which was the predominant form of investing prior to the Asian crisis, was really revealed to be fundamentally flawed. Because most all of the investments lost money. The reason they lost money is, of course, it was a crisis environment, so not easy to make money, but also in that environment, the sort of misalignment between an incumbent controlling shareholder and that new minority investor really got revealed. And of course, many of the private equity practitioners during that period tried to risk manage that potential for misalignment by having what they considered to be very protective shareholders agreements. And on paper, they did protect themselves. But the reality in the more emerging parts of Asia during the financial crisis was that those protections could not be enforced. Even in a court of law, it was unenforceable. And so, it wasn't really worth those protections weren't worth the paper that they were written on. Now, that value destruction then was so massive, and the recapitalization needs of Asia as a whole, and many, many hundreds, if not thousands, of Asian companies, that was that was what enabled control deals to really start to take off, because the amount of equity that was required to go into a company to solve its debt problems was so much that inevitably there would be a change of control, simply by the sheer dilution of existing shareholders. But in order to pay down the debt, so much new equity came in, the new equity provider almost invariably became the new controlling shareholder, and that's really when it sort of started.
So now we've come through to the global financial crisis. Asia came out of it relatively unscathed, I would say. You said that the global financial crisis opened the kimono, I think is the way you put it. And there's been a shakeout again within the industry. Yeah. So how do you see things progressing now then?
Like in many industries, they go through their cycles, and at the tail end of a bull market in any industry, there are always sort of excesses. And it takes a crisis to sort of wash away the excesses. I think what I meant by opening the kimono was the sense that in good times it's quite easy to make money, whether you're a great investor or an average investor or even a poor investor. But the strength of your investment strategies can be a little bit obscured by the rising tide that favors everybody. And so how do you look good when everybody's doing well? And it takes a receding tide to really reveal, well, who was relying on timing, who was relying on assets, ever-inflating assets, creating much higher multiples into which they sold, and who was really generating real intrinsic operating value. And so that's what I was meaning about the opening of the kimono. It's really that the return profile of investment strategy A versus B versus C is now looking quite different. In other words, the top quartile performance of the industry is quite good. The bottom quartile performance of the industry is quite terrible, and there's been a real bifurcation of returns. So that's what I meant about the opening of the kimono. Now going forward, there may be a bit of a shakeout, but the reality is that in private equity, because it's a long running asset class, it's a long holding period, it's not that a problem today causes a firm to shut down tomorrow. I mean, many of the firms that might have made poor investments 2 or 3 years ago, they're still with us, they still own their portfolio companies, they've still got to manage their way out of it. And the fact of the matter is that the period of pain that Asia has had to endure because of the global financial crisis has actually been so short, and the recovery has come back so quickly, that many of them will sort of just about do okay because they've got holding power, they've got stamina, and in fact the crisis hasn't been long enough really to create a shakeout. I mean, the ingredients of a shakeout were there, but the pain didn't last for long enough. And the other thing that will save the weaker performance, I would say, is that, and this was another point that I mentioned in my presentation, there is now in full relief the relative growth opportunity in Asia versus that of the more industrialized nations. It's now fully revealed that the growth differentials of the past, a lot of what was driving Europe and North America was too much leverage, and so those growth rates were clearly unsustainable. And so now you have a situation where most every investor sitting in Europe, sitting in North America, realizes that for the next 2 decades, let's say, economic growth rate, industry growth rates, company growth rates in Asia is going to be 2, 3, 4 times greater than that of their home markets. And so there will be, and there is already starting, a massive shift in the geographic allocation of assets from the industrialized markets into Asia. And that money will go to experienced hands, but there's going to be more money than the experienced hands can take. So even the inexperienced, the less successful will find their way to get new funds and keep on going.
As you were saying, that within Asia, the PE industry has gained legitimacy, whereas in the West it's reviled, basically. As you mentioned, in Germany, they're described as locusts.
Yeah. Well, that's right. I mean, I would say that the industry has become quite stigmatized, particularly in Europe. And I think the reason for that is that in an environment where you don't have growth, how do you create a good equity return? You have to focus on other levers, and typically those levers will be cost reduction. I mean, shuttering a factory, relocating jobs to cheaper locations. It's a painful, socially painful, a psychologically painful way to make money. And of course it does attract attention amongst politicians and voters and so on. And so in a way the industry is stigmatized in Europe now, and particularly in, as most European economies become slightly more socialist in their orientation, an industry that only thrives on driving efficiency is clearly one that's going to be somewhat reviled. Now you contrast that with Asia, where virtually all of our return profile doesn't come from firing people. In fact, we're creating jobs by the tens of thousands, hundreds of thousands, millions, because we're growing and we need to add factories, we need to add capacity, we need to hire new people. And so I think, the fact that private equity in Asia has a good name, and private equity in particularly Europe, continental Europe, has a bad name, is really just a function of, well, what drives an equity return in those markets? In Asia it's growth, in Europe it's largely financial engineering, which of course is reviled in and of itself, and it is sort of efficiency, driving efficiency gains.
So looking at the Asian markets, as we're hearing in Hong Kong and Super Return Asia that China is the hot market at the moment, with India behind it. But you were saying here at the INSEAD conference that Southeast Asia would be a good bet.
Today's cold market, the overlooked market, is where the opportunities are. And I think if you look at the flow of funds, private equity funds across the region right now, yes, India is hot. In my opinion, too hot. There are too many funds. I heard the other day there are approximately 500 private equity funds in India, up from probably only a handful in 2003, which is the first time Navis invested in India. And a lot of money is flowing into India, same thing into China. And only a fraction of the money that's flowing into India and into China is actually only a fraction or is flowing into Southeast Asia. And that seems like an anomaly to us, because actually when you look at Southeast Asia in the aggregate, which I think one can do now because of the ASEAN Free Trade Agreement, where tariffs on 90% of goods and services are down to zero, and so then you have the conditions for cross-border growth, cross-border M&A across this whole free trade area. When you aggregate that economy, it is approaching 1.8 trillion US dollars, 600 million people. Now India is an economy, it's more people, but its economy is only 1.3, 1.4 trillion. And so ASEAN is bigger, but it is only getting a fraction of the money that's going to India. The consequence of that is that to buy a company is much cheaper in Southeast Asia. There isn't the same number of private equity firms trying to buy those opportunities. And also deals are much, much less competitive. In fact, we rarely, and Navis is very Southeast Asian focused, we rarely compete with other private equity firms for our opportunities. We compete perhaps with local entrepreneurs, multinational companies, strategics and so on, but very rarely are we competing with other private equity firms. Whereas any deal in India, any deal in China is hotly contested by 5, 10, 15 private equity firms, all desperate to pay the price to get the deal. So.
As a GP, you have $3 billion under management. Which countries in particular are you looking at, and which sectors? I mean, you said that Malaysia only makes up something like 5% of your portfolio, even though you're based in KL.
Yeah. Probably 5 to 10% is in Malaysia. I mean, I would rather think about that question in the context of Southeast Asia, because the most powerful value creation phenomenon that we like right now is enabled by AFTA, the ASEAN Free Trade Agreement. And what it really means is taking a national champion, whether it's in Thailand, whether it's in Singapore, whether it's in Indonesia, whether it's in Malaysia, and going cross-border and turning it into a regional champion. And to us, that's the most attractive investment. It doesn't really matter what the starting point is, whether it's Thailand, whether it's Malaysia, but take a great brand, take it into its contiguous markets. Instead of addressing, in the case of Malaysia, less than 30 million consumers, address the full 600 million consumers in ASEAN. To us, that's a very, very powerful opportunity. We've done it before when there were tariff barriers with baby diapers and other sort of branded, fast-moving consumer goods. Right now, we're doing it, interesting enough, with a color cosmetics, mass-market color cosmetics business called Silky Girl, #1 in Malaysia. We're taking it into Indonesia, Vietnam, and massively increasing, the number of consumers that we're targeting.
In China, in terms of exit strategy, it seems to all be about IPOs, and that also has that sort of quality assurance in terms of the companies that are on the table. So is that similar within Southeast Asia?
I don't think so. I think the IPO markets are much less hot, for want of a better word, in Southeast Asia, particularly for a sort of small to medium-sized enterprise. And so from our point of view, any company you buy must have the characteristics that will be attractive to a trade buyer. And in fact, in the whole of Navis's history, none of our exits have been to the public markets. 80% of them have been to trade buyers and the other 20% to financial buyers. And that's just because it's one thing to exit to an IPO when you're a minority investor. If you have 15% of a company and it lists, it's quite easy for the small minority investor to get out, especially when there's an ongoing controlling shareholder who's staying in for the long run. But when you own 85%, when, as we do, 100% of a company, getting out to the public markets is very, very difficult indeed. And therefore, the clean exit to the trade buyer is infinitely preferable.
A number of Western LPs say that they have allocations of, say, 5-10% for Asia, but they haven't actually been using it. How would you convince LPs in the West that they really should be putting their money into these markets?
I don't think they need any convincing, to be honest. What they're looking for are the fact that they have that 5 to 10% allocation is evidence that they know that they should be in those markets. What's inhibiting them is not the sense that Asia's risky or whatever it is. They haven't been able to find private equity fund managers where they can see enough of a track record to convince them that these are experienced. And as I said, in India, if there are 500 funds and yet you're an LP sitting in New York or Boston or London or Paris, how on earth are you going to find out which of those 500 are really experienced, know what they're doing, where more likely than not they're going to do a good job in their investing? It's practically impossible. So with so much choice, but so much sort of fragmentation, it takes quite a long time to develop the fact base to enable a thoughtful decision about which fund amongst the hundreds I could choose from am I going to pick. And so it's a matter of time. It's a matter of education and time. But I don't think I don't think there's any need to educate people about Asia. I think every fund manager I've spoken to internationally outside of Asia knows that an ever-increasing proportion of their assets that they're managing has to find its way in one way or another into Asia.
Nick Bloy of Navis Capital, thanks a lot.
Thank you.